At the beginning of the year, all of us had concerns about China. The Chinese currency was depreciating. Oil prices were at $28 with expectations of going to $20 or so, leading to risk for a lot of economies which are dependent on oil, or a lot of companies and economies which are dependent on oil. There were concerns about the US election results. What would the US Federal Reserve do during the year? Concerns about Brexit and Europe. And at the beginning of the year, had I told you that there would be Brexit, UK would come out of the EU, Donald Trump will win the US elections, you would have one Fed rate hike, you would have terrorist attack in Europe, the Chinese currency renminbi will go from 6.4 to 6.9, so on and so forth. One would have said that that would have been time to be extremely risk averse as far as the global markets are concerned. The fact is, at the end of the year, despite all these events, the US equities were close to a new high. US bond yields went up almost 100 basis points. Commodity prices had a very decent rally. And I think if we look at all these markets, it looks like that the collective wisdom of market participants is telling us that the global economy is on a mend. Despite the Brexit, the UK equities are at a close to a historic high. Of course, one can say that because of the weaker sterling and the exporters have benefited from that or whatever. But the fact is that despite all these political events or the geopolitical concerns, the underlying economy seems to be on a mend. The global economy seems to be on a mend, which is reflected in the markets where bond yields are going up, equity markets are going up, and commodity prices have gone up. When does that happen? All these put together, commodities, bonds, prices, the bond yields go up and equity prices go up, when you are expecting growth to come back, when you are expecting inflation to come back. Now, since the global financial crisis in 2008-9, the central banks took on the mantle of promoting the global growth by printing more money, by cutting interest rates, by forward guidance, all kinds of unconventional measures. But it looks like that the underlying economy, after a slowdown of couple of years, seems to be recovering. And if you look at the variety of data, if you look at the unemployment rate in US, which is at a historically lowest level in last 10 years, since the global financial crisis. Same thing in Europe, same thing in Japan, same thing in a couple of other economies. The jobs are getting created. It seems that if you look at whether the industrial data and PMI data in Europe, if you look at the PPI, the Producer Price Index in China, which was up 5.5%, all these data are indicating that there is some signs of recovery in the global economy. And that's why all these geopolitical concerns or the political developments, which may sound very disturbing, given that the far right people like Donald Trump or the Brexit or the referendum in Italy where people voted for no for the constitutional reforms, or similar expectations going forward in Europe, concerns about China, the markets are telling us that there is bit of recovery in the global economy, which is a positive news. In fact, in last 3 months, we have seen Indian exports picking up, and that's a positive news for us. Now, going forward, of course, we'll have to wait and watch. On 20th of this month, Mr. Donald Trump will assume the office of the President of US, and we have to see our view is that election rhetoric is one thing. He might have said a lot of things about the trade treaties to be renegotiated, or having a wall against Mexico, or on immigration and several things. Our sense is that the true Trumpnomics would be more about taxation reforms, more about deregulation, more about infrastructure spending in the US. In last 7-8 years, since the global financial crisis, as I mentioned earlier, that the global central banks were printing more money or were on an accommodative policy, I think we are entering a period where we will have maybe the monetary tightening in some places or less accommodation in other places, while the fiscal policy will start playing a bigger role in promoting the economic growth, starting with US. But I have no doubt in my mind, I think we are going to see similar policies to be pursued in Europe and other parts of the developed world, which is a positive news for the world. You look at it, since the global financial crisis, any economic data in these countries, let's say the US payrolls data, if they are weak, meaning that in US the unemployment rate is increasing, or the consumer confidence is going down, or the industrial production is going down, equity market goes up. Now that's quite funny and interesting. Why equity market should go up when the economic data is poor? But because market thinks that poor data will lead to US Federal Reserve printing more money or cutting interest rates further or having more accommodative policy is good for the market. So markets have been markets have cheered every time there was a poor economic data, and markets got nervous when there was a positive economic data. I think we are coming out of that period, and next few years the global markets would be more driven by the underlying economic data rather than the monetary policy, and I think which is quite good structurally going forward. Now getting into 2017, of course, again, like at the beginning of 2016, there are concerns about China. In last 10 years or so, at a time when the global economy has hardly moved in terms of economic growth, the size of the global economy hasn't moved much since the global financial crisis, but the China's GDP has gone almost 5 times, from $2 trillion to $10 trillion. But at the same time, the debt levels have gone up very significantly, many-fold. And that's why every year there is a concern that what happens because of the what happens if there are more outflows from China, if there is a more pressure on the currency, if the debt overhang at some point in time will create some challenges for the economy. And then in 2017 is no different. So at the beginning of the year, like last 2 years or so, I think you get worried about China. Last year they pulled it off very nicely. They seem to be taking the right step in terms of cutting down on some of the capacities, ensuring that some of the sectors where there was like an overhang of overcapacity, they are trying to address that, giving the fiscal stimulus in the right places. But again, given the large size of the debt compared to the size of the GDP, there are always concerns about it, and we'll have to wait and watch. There are concerns about a lot of elections in the Europe next year. So after the Brexit vote, there are elections in Italy, there are elections in France. By the end of 2016, nomination for the elections in Germany. And I think it seems that post-Brexit and post the election of Donald Trump, the right-wing leaders, more nationalist leaders, leaders who don't believe in the immigration or globalization, they are becoming more popular, and there is a concern again that people will start questioning about the Eurozone next year. And of course the geopolitical risk in the Middle East, where elections in Iran, and also what happens in Saudi Arabia, where we had a regime change, and how things pan out there. But I would say that again, last year we had a similar situation globally, where there was a lot of attention of market participants on the geopolitical event, but the underlying economy was showing signs of improvement, and somehow people neglected that. But markets are clearly telling us that we need to focus a lot more on that. And as I mentioned earlier, if I look at the economic data, whether in US, whether in Europe, whether in Japan, things seem to be improving. Now coming to India, think about it. Had the 8th November demonetization and had the 8th November Donald Trump victory and some of the other reasons like the outflows from the emerging markets and India got FII outflows had not happened, how my talk would have been at the beginning of this year? I would have said that last year we had a very good monsoon. I would have said that we will have a very good recovery in the rural economy. Agriculture production is good. The sowing has been well above expectations. We had the 7th pay commission payout. The government spending, particularly on the infrastructure, seemed to be picking up. And we had very good reforms last year. In fact, some of the path-breaking reforms happened in 2016. You look at the bankruptcy code, you look at the GST, you look at the monetary policy committee formation, you look at the Aadhaar bill, real estate regulatory bill. I mean, there are so many, and also from the RBI's perspective, both the recognition and the resolution of the NPA process, you had a lot of good reforms last year. Several of these reforms have been pending for a very, very long time, but we saw them, all of them saw the light of the day last year. Now, despite all the good economic reforms, despite the global tailwind, I mean, we had a headwind from the global economy. Last 3 months, as I mentioned earlier, exports are picking up. So there is a global tailwind now, things are improving. And despite that, the markets did not deliver good returns. So last year, in calendar year 2016, the Sensex was up just 2%. In fact, by Christmas, we were looking at a year which could have been negative on returns. Of course, the mid-cap index delivered better, and most of the investors in the mutual funds couldn't feel that market did not deliver returns, because by and large, diversified equity funds and even large-cap funds delivered decent returns, similar to maybe a fixed deposit or slightly better than fixed income. So I think people were happy. Last year, you also saw bond yields going down very significantly. So 10-year bond yield, I think, fell around 125 basis points. You had a 50 basis point policy rate cut. So from an overall macro perspective, and also all the other macro data, whether you look at fiscal deficit, you look at the current account deficit, you look at foreign exchange reserves, balance of payment, most of the overall macro parameters, the reforms happened, and the domestic investors had the huge faith. We had record flows again for third consecutive year in equity market, but markets did not deliver return. And my point is that I'll talk a little bit about demonetization in a minute's time, but my point is I think maybe the earnings recovery which was expected at the beginning of the year did not materialize, and I think that's the most important thing in the 2017, while a lot of attention will remain on all these politics and the geopolitics and the global environment, but the most critical thing next year for markets to deliver good return would be on the earnings front. Now I'll take few minutes on the demonetization and its impact. I think we had the last call on 9th November, where this was the very next day of the demonetization, and our view was that along with all the other measures that government has taken in last 2 years or so, I think all these, including the demonetization, will go a long way in ensuring 2 or 3 things. Number one, that a large part of the parallel economy will come to the mainstream economy, and that will lead to higher tax revenue. So the tax to GDP ratio will go up, and that will also lead to higher financial savings. As finance becomes more digital, I think we will have more savings coming into the financial markets, household savings coming into the financial markets, and structurally it is quite positive. Of course, in last 2 months, a lot has been said about the demonetization, a lot has been discussed, so much of analysis, and on a very, very lighter note. On a very lighter note, I would say that I think post 8th November, I mean, we have produced thousands of economists in India, and everybody has got a strong view on how much would be the GDP growth next year. And I think I would, with all the humility, I would say that I think given the magnitude of this event is so big. I think no country in the world has done something like this. We have not done in anything like this in our history. It's too early to really, judge the impact on the economy in next few quarters. And I think there are so many moving parts. And based on the anecdotal evidence, depending on who are you talking to, if you're talking to some small businesses here and there, you would say, no, things are pretty disappointing, pretty sluggish in several segments of businesses. You talk to some other companies which have benefited because the trade has moved from unorganized to organized sector. You look at the overall flows into the mutual funds, insurance industry, for the banks overall it has been positive. So you get different kinds of feedback from different people depending on who are you talking to. Surprisingly, as per the media reports, the registration for real estate in several parts of the country were quite good. You also had some of the retailers and the stores were saying their sales were like quite good. Maybe people were using the currency that they had. So as I said, that we are such a complex country and it's too early to really write a final view on this. Having said that, without getting in too much into the numbers or trying to give a firm view on where the GDP is headed or how it will impact various other economic parameters, if we simply analyze and see the impact of the demonetization to us, I think there are three large impacts. The number one is the liquidity effect. You took out 86% of the currency in circulation. So the medium of exchange, which really is the lifeblood of all the economic activity, 86% of that went out. Initially, you had a 2,000 rupee note. So what happens if I have to buy 1 kilo of apple and buy for 200 rupees and I give a 2,000 rupee note, the person has to give me 3 500 rupee note and 300 rupee note, and those notes were not in circulation, and that's why the liquidity effect led to the slowdown in the economic activity. And we believe that another a month or two, when the liquidity comes back to system, to a large extent things should get normalized, which got impacted purely because of the liquidity effect initially. Now the number two impact is the wealth effect, where some of the people, let's say, if they are not able to transact in the real estate the way the market has been historically, and the involvement of the parallel economy there, because of that, or let's say even if those people who have money but they cannot spend because they have a fear that somebody is watching them, I think that's more permanent, and which will impact more the conspicuous consumption. It will impact high-end consumption, it will impact luxury spending, and that will be, I think, for a very, very long time it is likely to persist. The third impact is the income effect. Income effect is for lots of businesses in India, the way those businesses have been run. So let's say a plywood shop, or somebody who deals in sanitary ware, or somebody who deals in let's say high-end textile or whatever, and they buy or sell goods from people where it is part of it is unaccounted or fully unaccounted. Now they have to completely reorient their business model. Now of course it will take some time for them. A lot of professionals who take money in cash, for them to go back to go towards a system where everything has to be taken in a digital currency, or everything has to be accounted for, and then they have to go for the tax returns. I think it will take some time for them to reorient. But think about it. What is the choice for those people? As the government is tightening its, the government is making it increasingly tougher for people to really stay out of that tax network. I think businesses have to reorient themselves, and I'm quite confident that in next few quarters most of these people will realize that they need to redesign their business model, they need to come to the mainstream, and things will start moving in the right direction. That can, I think, probably slow down the economy for a few quarters, and also it will depend on the implementation of the GST, how much that impact. But I think, as I mentioned, the liquidity effect, the wealth effect, and the income effect, the liquidity effect should not be there after a month or so, and things should become normalized for a large part of the country. The wealth effect, which will impact the high-end spending, I think is going to be a much more long-term impact. It will impact the high-end spending for a long time. And the income effect, I think a large part of the business community in India, a large number of professionals will redesign their business model, and I think, I'm sure they will come to the mainstream and things would become normalized. Over a longer period, there is no doubt about it, despite all the criticism about the implementation of this, or a lot of things that could have been done in a different manner. On hindsight, it's very easy to say that, but I think structurally it is a positive move. It will make the finance more digital, and as I mentioned, once that becomes, it improves the overall productivity for the economy. Now going forward, as I mentioned, that next year, while again people will focus a lot on what happens in budget on 1st February, then what happens in terms of the overall impact of the demonetization, you will have the UP elections. I told you about lots of global events, and I think they will consume a lot of our attention. But the fact is, I think next 1 year the most important thing would be the trajectory of the corporate earnings. Looking at the fact that last 5 years the growth has been pretty sluggish, I think if we expect that corporate profit growth would come back to normal which is like, let's say, at least in line with the nominal GDP growth, which is 12-13%, then given the valuation where they are today, and given the liquidity flows, which is likely to be stable, particularly from the domestic investors, then markets should at least deliver those returns in next 1 year. One of the more interesting thing before we open up for question and answers is on a lot of people when they look at the ground level commentary. Now, you have logged in from different parts of the country, and I'm sure if you talk to, let's say, a textile producer in Ludhiana or a textile producer in Ichalkaranji or a Tirupur, or if you talk to rolling mills in Calcutta, you talk to some other industrialist in Muradabad or Jaipur, I think in general you get a pretty, I would say, from lots of these businesses are facing trouble. But as I mentioned, a lot of it is due to liquidity effect, which will kind of wear off. But I think it's impacting sentiments also, and for a lot of investors also. And I think one thing we should keep in mind that if we look at the composition of the index and the composition of the corporate earnings, I think the impact that demonetization can have over the next few quarters is very limited. Now, it may sound quite counterintuitive that despite so much of impact on the domestic economy, why the market will remain completely insulated. Why am I making that point? And the point is that around half of our earnings, half may not be a right number, but around 40% plus of our earnings, whether you look at Sensex or Nifty or BSE 100 or 500, actually depend more on the external factors. So let's say in the index you have around 10% of the index is IT stocks. They may get impacted by immigration laws in US, they may get impacted by currency, they may get impacted by US economy or European economy, but will have very little impact from what happens because of the demonetization in India. You look at 6-7% in healthcare, they may have impact from US FDA, they may have impact from again the currency or the global environment, the global drug pricing policy in US, but much lesser from what happens because of the demonetization. Almost 20% of market, which is like oil and gas, utilities, mining, global commodities like metals and all, will have very little impact because they are again are more driven by other factors than what happens to consumption from the demonetization and the impact from the demonetization. You have consumer staples may have got impacted because of the liquidity effect that I talked about. Maybe if there is less amount of cash in the system, people are not able to buy even, let's say, grocery, or they are not able to buy a toothpaste or noodles. But I think another month or two things should become normal, which is again 10-11% of the market. Now that leaves you with two sectors. One is the consumer discretionary, which is a discretionary consumption. And as I said that maybe the high-end spending because of the wealth effect from demonetization may get impacted. But I think structurally next year again, if the rural economy does well, if the government spending happens, if we have, hopefully, normally after the one good monsoon, you have a second good monsoon in the next year. And I think if you have the overall global tailwinds, then I think things should go back to the normal level. In fact, with the GST, a larger move is likely to happen from the unorganized to organized sector, even in the discretionary spending. So they will get impacted because of, as I mentioned, liquidity effect, wealth effect and income effect, maybe for a few quarters, but structurally it is not so negative for them, barring the high-end spending. That leaves you with one large sector, which is financials, which is your banking and NBFC and all. There, if this slowdown persists for long, if this situation deteriorates further, which is like very small possibility and we are not expecting that to happen, but God forbid if that happens, and because of that, if you have more NPAs on the retail side, where even a professional or even a small business comes under stress and there is a larger balance sheet challenge across the country, of course financials will have a challenge. People including us are concerned about loan against property portfolio, or let's say commercial vehicle portfolio, or let's put on the second hand side, or maybe some of that personal loans, etc. But barring that, structurally this move per se is positive for the financial sectors. As I mentioned, again to repeat the same point, I might have mentioned the same thing on an earlier call, that the digitalization of finance is structurally quite positive for the financial sector, because as more and more savings flow through the digital side, more and more transactions flow to the digital side. It improves their productivity, and as the savings become more financialized, banks will be in a position to sell more mutual funds, sell more insurance policies, more credit cards, more debit cards, more mortgages. And I think at the overall, a lot of the informal lending that happens in the country today, I think starts moving towards the formal channel as businesses become more formal. So structurally it should be quite positive. Of course, you had a very low credit growth recently because a lot of people have actually paid their borrowings by using the earlier cash notes and all, but structurally it is positive for the financial sector, but for the a small possibility of a larger balance sheet issue. So from that perspective, I think that people are concerned about the demonetization and the impact of the market. It may impact if the slowdown persists, but I think the impact may be less, and there are other factors also which can drive the market. And as I mentioned, next year the most important thing would be the earnings growth. I'll take maybe 2 minutes about the one last point that I want to make about the bond market, that I think the markets were expecting a rate cut in December. Our view was that looking at the global environment where US Federal Reserve has increased interest rate, globally the bond yields are going up. Almost every single country in the world, both in the developed markets and in the emerging markets, have seen bond yields going up. Oil prices have moved up, currency has depreciated a little bit. So overall, the room for policy rate cut in December was limited. Of course, because of the demonetization, a lot of deposit growth has happened. Think about it. Had this move not happened on 8th November, would the lending rates or deposit rates and bond yields have gone down so much? Not really, highly unlikely. Yields would not have gone down so much, but they have gone down primarily because of the demonetization, the fiscal gain that can come to the government next year from better tax revenues, and the deposit growth that has happened with the banking system, and credit growth has gone down. Because of that, the bond yields and the deposit and the lending rates have gone down. But going forward, there is a small window of a rate cut in February meeting. But structurally next year, if the global economy is doing well, if inflationary pressures are emerging globally, then we are not in the camp that there could be a huge number of rate cuts going forward in 2017. So structurally, as the overall fiscal position improves, as the food production is good, liquidity situation is normalized, bond yields may stay at these levels but unlikely to fall substantially from the current levels. There could be tactical moves, there could be technical factors. For example, there's a lot of inflows that have come into the savings bank, into the postal savings, and because of that the government may borrow less money, or there could be a large money flow to government because of the income disclosure scheme, and they cancel another 1 or 2 auctions, and because of that there is a rally. But structurally, if the global bond yields are moving up, then I think India can't be completely insulated, and it cannot that Indian bond yields go down very substantially while the bond yields keep going up in rest of the world. So I think we would have a more neutral view, while the medium term view remains positive because of the structural positive on the fiscal side. And as India's savings rate improve, you would have a structurally lot of demand coming in from the mutual funds, insurance, provident funds and all, which could be good from the interest rate perspective. And if we are able to achieve a 4-5% inflation on a structural basis, risk premium on bonds can structurally go down. So with these words, I'll close, and will be very happy to take any questions on not only on the markets, but even we can discuss our fund positioning as well as the views that we have both on the equity and fixed income funds individually. Thank you so much.